بسم الله والحمد لله والصلاة والسلام على رسول الله اللهم علمنا ما ينفعنا وانفعنا بما علمتنا وزدنا علما. Hello everyone, this is Liquidity Club by Ahmed Shawi. Today is Sunday, actually today is Saturday, the 7th of December 2024. Um, I should have uploaded this review yesterday, but I was so tired, so I'll be doing it today. It's pretty much a review for the trade that I took yesterday. I did take some shorts. Now, I took some trades here on Wednesday, but if you want me to review this trade, like targeting the new week opening gap, I can do that. But our main concern here about like today's review is going to be about Friday and how I traded after the NFP. So let's get started. I have traded the S&P ES, which is called, because since I'm trading the indices, it is called the US 500. And I'm gonna be going over why did I choose the US 500 or the S&P 500 or like the ES over the NQ. I don't trade the Dow Jones. It could have printed a smooth move yesterday, but I do not trade. I do not trade Dow Jones because of like the messy price action that it produces. So let's get started. Starting with the 4-hour time frame chart, I'm gonna be going into like a top-down breakdown of the trade to pretty much show you what I process things when I'm trading. So starting from the higher time frame all the way to the 1 minute time frame chart. And just for you to know that I have it uploaded as a video. So I took a video while taking the executions, like stop loss management, all of that thing. I already have a video like recording it. It's already recorded. So if you want to see the recording of the trade, let me know. But I think a breakdown or like a review of the trade is better than the recording itself because the recording can be a bit ambiguous. So I'm here to just clear up the ambiguity and make things clear. Starting with the 4-hour time frame chart, we had a high here that was printed late like in Wednesday, the 5th of December. So the high that was printed here, price printed that high and started running down lower. On NFP Friday, yesterday, we've seen price just open, trade down lower, take out the sell side liquidity that's residing here, and then just rally up higher, taking out the buy side liquidity. After price has took out the buy side liquidity, all I was thinking of is shorting because we have pretty much fulfilled the external range liquidity. So what can I be looking at? I'll be looking for anything that is considered an internal range liquidity. So let's drop down to the 1 minute time frame chart. You can see this is NFP where price has opened, broke down lower here, and then rallied up higher. After rallied up higher, a bit of consolidation here, which is our main like concern here. This is what I'm focusing at right now. This consolidation, and then at 9:30 opening bell, we've seen price surge up higher. You see like this would be like the manipulation, and then we started seeing price break down lower. So you see, this is the consolidation that was created after NFP move. So NFP, then consolidation, and then at 9:30 price continued running up higher, a bit of a manipulation here, and then we started breaking down lower. So this is the buy side liquidity from the higher time frame chart right there. I'm going down to the 1 minute time frame chart. I'll show you, I'll break it down to you now. Why I chose the ES over NQ. The the chart at the bottom is NQ. You can see the price levels here represents NQ chart, and the chart on the top it's ES. You can see that on ES we have formed a high and then a lower high right there, whereas NQ has formed a high and then a higher high, which means that NQ is, or let me rephrase it in another word, that ES is weaker to the downside and NQ is refusing to trade down lower for lower prices. So it's refusing to tank down lower because it has the fuel to run up higher and take out the buy side liquidity, as you can see right there. It has formed a higher high. So it's not being rejecting the highs. It's just running up higher. It doesn't have, for ES, it couldn't take out this high. Even like here, you can see all these highs. It couldn't take out this high, which means it is weaker to the downside. It's wanting to reach for lower prices. So if you're trying to short, which logically, which one would you be shorting? Since ES has showed us that it's weaker to the downside. So if you really want to be shorting in this condition, shorting ES would be more profitable because it is showing you signs here. SMT is the sign that it is wanting to break down lower. It's wanting to be weaker to the downside. It's wanting to tank down lower. So it's better for you to trade ES over NQ, and vice versa. When we're trying to go for some longs, you will see, hypothetically speaking, as an example, ES, let's say, it has formed a lower low, whereas NQ has formed a higher low, which means NQ, as in the hypothetical example, NQ is refusing to take out that low, which means it's stronger to the upside. So if you're trying to go long in that hypothetical example, longing or going long on NQ would be more profitable and beneficial for you because NQ is stronger to the upside. I hope I made it clear why I chose ES over NQ. So to go over the trade, you've seen price has formed that SNT. After the SNT has been formed, I know that this high is pretty much protected right there. This high is protected because of the SMT. So I went short here, and I added some positions at the institutional order flow entry drill, the inversion favor gap, the bearish mitigation block. You see, I drew this diagonal line here just to show you, while in the live recording of me trading it, that a lot of retail traders are looking at this and trusting it as means of support. Every time price just retracing, you can see the touches here, you can see the touch here, and the run up higher here a little bit. All of these is just tricking retail into trusting it as a means of support, that they can long here. They can pretty much trail their stop loss, or they can long, because you see how price touched that hypothetical diagonal line. Because, like, let's be real, the market doesn't look at these lines, but retail traders will be like making these up just to have something to believe, to depend on. So price retrace here touched that hypothetical diagonal line that they are drawing on the charts, and it has moved. It didn't move because of the diagonal line right there. It moved because the algo wants to move up higher, take out some liquidity, some fuel that is residing above this high. You can see how it took out that high and started breaking down lower. We have this inversion favor gap right there. It is a favor gap, but once we trade it and closed below it right there, it is considered as an inversion favor gap. You can see how price, after we closed it below it, price started respecting it and treating it as means of resistance. This is where your real support and resistance will reside, not the diagonal lines here. These are just nonsense. You can see there's a lot of BD arrays that are evolving around this area. We have the inversion favor gap, the institutional order flow entry drill right there. It's a favor gap, but it is an institutional order flow entry drill because price didn't reach to the reinforcement of that favor gap. And we have the buy side liquidity, which price treated as means of resistance here. You can see it's just working around it. And we have the bearish mitigation block. I'm choosing this candle, the low of this candle, and the high of this candle. If some things do seem complicated, I'd love to know by writing a comment down below the video, so I can emphasize more on things that seem complicated to you. Anyway, so price then broke down lower. So my main concern is here on this slide is just show you why I chose ES over NQ. Going to the next one, here, like, here's the source. Here's like where everything we're going to be talking about. You see, This is where we opened, which means this is the opening range gap high, and we have the sell side liquidity. This is the consolidation I talked about after the NFP. You can see the time. You can go rewind the video and you see the consolidation that I'm talking about. This is what I was aiming at as means of the internal range liquidity that I want to see price reach to right here. This is what I was thinking about when we were trading here. This is what I was thinking about right there. This is liquidity. I had this in mind, and I knew that we're going to be trading in a high resistance liquidity run. So the example or the review of this trade, it is a trade that I took, some shorts that I took in a high resistance liquidity run condition. It's a low probability condition because it's just after NFP, there's been a surge of liquidity into the marketplace, and the market is still pretty much reviving from that surge of liquidity. So anyway, I've already explained things over here. Price started breaking down lower. We have a bearish breaker right there. This is a high, low, higher high right there. We took out the liquidity over here and then breaking down lower, which makes this as the bearish breaker. Price retraced. Price broke down lower. My first target is the first partial that I took. You see soon I'll show you the executions, but let's just focus on my main concern is to teach you. My main concern is to teach you how to read the markets. It's not about the executions. I'll show you the executions later, but the executions is not my concern. What I'm doing here is not actually what I'm doing here is just for my children. I want my children to know how to read the markets. That's my first and main concern. How can I teach the skill set? How can I teach the skill set of reading the market, not making money? Because once you have the skill set, you can do unbelievable things with the skill set. So my concern is not making the money. My concern is to teach you how you can read the market well, how you can read the price without the needing of an indicator or someone to tell you, oh, look at these targets, look at this, look at that. No, you are going to do that by yourself without the help of me, without the help of anyone. You're going to be responsible for everything you're going to be doing. So the first partial that I took was right below this level, this low, sorry. Why? Because it's the first low below the equilibrium of the implied dealing range. What is the implied dealing range? It is a dealing range that I have in mind before it's even created. So we have this low to this high. That is a dealing range. So if we have this dealing range from this low to this high, we have this is the equilibrium. Equilibrium is the midpoint of that dealing range. If I want to go short, I'm going to go short in premium and cover my shorts in discount. And vice versa, when I'm going long, I'll go long in discount and I'll take profits or I'll close my longs in premium. That is the main idea of trading. Even when trading in real life, you are going to do the same thing. It's nowhere different from real life situation. When you're in a real life situation, you want to buy things in discount and potentially sell them in premium. So we're trying to mimic the same thing that is going in real life. That's what's happening in real life in trading. How you can get things cheaper at a discount price and you can sell them later at a premium price where you can make profit out of it. And the vice versa when you're trying to short something that's expensive and cover your shorts when it's cheap. That's you're making profits in two ways. So in this example, we're making money shorting. So we're shorting in premium and then we're covering our shorts in discount. So the first area of covering my shorts in discount is below this equilibrium price level. So the first low below this level is these two relative equal lows. So I chose this low and this is where I took the first partial. So I hope it's clear why I have this as the first partial, because it is the first low. You can look at a volume imbalance or you can look at a fair value gap here, but I like to look at lows and highs just below or above the equilibrium of the dealing range. That's how I do it. and this would be the terminus. So that's the terminus, that's the origin of the trade. This would be the equilibrium. Below the equilibrium, we have this low. So I'll be taking my first partial, the low hanging fruit, just below this low. I'll be training my stop loss to break even. So if price wants to break up higher, uh, I'd booked some profits here and it can just take me out in a break even. I'll still make money on the day. So price broke down lower, reached to my first partial here, a bit of a consolidation going into lunch, which formed another sell side liquidity here. I've marked it as a sell side liquidity and price right all the way up higher to the bearish breaker right there, to the favorite gap. We have a SIBI, sell side imbalance, buy side inefficiency. You can see it doesn't even reach to the encroachment of that, or the midpoint of that favorite gap. And you can see how the bodies of the candles, the wicks are just doing damage here, but the bodies are respecting the bearish breaker. And then we see the price, a bit of consolidation here, price started breaking down lower. This is a turtle soup. I took some shorts as well here, and price. And why did I take some shorts here? Because if you measure it, so some people say like you're shorting in discount. No, I'm not shorting in discount. I know what I'm doing. If you take the dealing range here again one more time, this is the equilibrium, and well, I'm shorting above the equilibrium. Equilibrium is like at this high. I'm shorting above this high. So I'm shorting in premium. Again, I'm following what I'm teach. I'm not teaching you something, or what I'm doing here in this review, in this trade review. I'm not showing you or teaching you something that I'm not doing. No, I'm preaching what I do. I'm teaching you what I do in my trading. A lot of people who are like teaching about trading, they'll be teaching things that they're not using. They just they just want to teach you things that it might not be beneficial, but I'm teaching you the things that matters the most, the things that I use them in my trading, the things that are beneficial for you, the things that you can utilize to actually catch like these trades that I took and I captured yesterday. So price, I shorted some here. Price broke down lower. I have a retracement here to that CB right there. Another run up higher here. You see, these are the signatures, the hallmarks of a high resistance liquidity runs. A low probability condition. Price is just having a deeper retracements. A lot of turtle soups, as you can see. Turtle soup here, turtle soup here, turtle soup here, turtle soup here. Deeper retracements. For some people, it might not be the condition or the environment that they want to be trading at, and I totally understand it. Totally understandable. But for me, I know how to deal up with these type of environment, these type of conditions by just not trading my stop loss too tight, because the market is going to have, as I've mentioned, a deeper retracement that many people are going to be bearing or like getting used to. Some people, like when they see this kind of retracement, they'll be losing their mind. Oh, my market is just reversing from here and it will take my stop loss. So what? I'm not concerned with these kind of thoughts. So I always have my stop loss in a protective level, especially when I'm like expecting a high resistance liquidity run or a low probability condition. So anyway, price broke down lower here. We have a high here that was formed into the SIBI. Price broke down lower a little bit, forming a relative equal lows here, as you can see. And then it traded up higher one more time, taking out this high. That's a turtle soup here as well. And then we started breaking down lower. So this means that this is a bearish breaker. Price broke down lower here, took out the sell side liquidity and reached the opening range gap high. So I took some profits here below the sell side liquidity and below this opening range gap high. And then price has a retracement here. High, higher high, higher high here. It's just forming higher highs, trying to take out some fuel, take out some liquidity that can pretty much help the price, help the market to just push down lower to the target here, to the sell side liquidity. So we formed a low here that is equal low with this low and relative equal low with this low here. So there's pretty much sell side liquidity residing here. a retracement here, turtle soup as well, reaching to that bearish breaker, and then breaking down lower. That's a mitigation block. We have a high, low, lower high. So that's a mitigation block. So we're looking at this down close candle as a bearish mitigation block. Price retraced. We also have a SIBI here, favorite gap. If you can zoom in, you'll see that small favorite gap, small SIBI. Price retraced to the constant encroachment or the midpoint of that favorite gap and started breaking down lower. We have a retracement here, and then we just broke down lower. I took the majority, like I took my trade off here. The terminus was here, and that was my trade. That was pretty much it. So uh, you can have questions in mind, and it's totally fine. You can ask them in the question down below. So I'll be able to emphasize on the things that you ask. So I can potentially create more content or create more educational video about the things that you have questions about. So now let's go with the executions. Here you can see shorting here, knowing that this high is protected. I have my stop loss right at this high. Price broke down lower here. Institutional order flow entered the right there. More shorts here, more shorts here. The inversion favorite gap as well here. And then price broke down lower here. Retracement, that's turtle soup, and the favorite gap, the bearish breaker. A lot of things are pretty much around this price level here. So I shorted more here. I took some profits. So when price broke down lower here, I took some profits as I mentioned, the first portion right there. And then price broke up higher, took some shorts, consolidation, price broke down lower. A retracement here just to show you that I can short that. I shorted here, the SIBI, knowing that price is just pushing to the downside. Retracement here, the total stop, and then broke down lower. I took some profits here, the range gap high, and this is liquidity. So this is where I took some profits. We formed this low, bit of retracement here, then broke down lower. I took all of my position right there, and that was pretty much it. So this is the trade. You can see that execution labels here. How I shorted. You can do the math. It will be a zero sum. I didn't have any positions left over. That's the whole position that I had. So I hope that it's clear to you what I have shared in this trade review. This was a New York AM session trade that extended to lunch or early PM session of Friday, the 6th of December 2024. I'll go over NQ and Dow Jones to show you what happened in those asset classes or these markets, these indices when ES was trading down lower. You can see Nasdaq after the SMT, it didn't move any lower than how ES did trade down lower. Like you see the opening range gap high here, it didn't even like come close to it. Why? Because of the SMT. Just because of the SMT, it showed me that it's better for me to trade ES over NQ. Yeah, I could have traded NQ and I would have gone like just this consolidation. I would have gone anywhere. But because I've utilized the SMT as a must in my trading activities, that helped me know that I'm better off trading ES over NQ because ES is weaker to the downside. And you can see Dow Jones is just breaking down lower. Took actually NFP's low, as you can see right there. This is NFP low was traded down and swept over here. So I would have traded this, but as I've mentioned, I don't like trading Dow Jones mainly because of the sloppy price action. Now imagine a sloppy price action as the natural tendency of Dow Jones, and add one more thing that it is a high resistance liquidity run or like a low probability condition. So it is a really bad market to be trading. If it would have been a high probability or a low resistance liquidity run, I might have traded it, but I haven't traded, and I don't think I'm gonna be trading Dow Jones in my life. I'm just using it as a parameter to look about how the market moves in accordance with the NQ and ES. Like I'm just using it as a parameter to look at the markets. So you can see how there was pretty much a decoupling here. Inky was pretty much consolidation running up higher here. Dow Jones running down lower. A bit of consolidation was like declining to the downside, running down lower. ES the same thing. It was pushing down lower, and this is like the one that I traded. So I really hope you found this one insightful. If you have any questions, do not hesitate to ask me in the comment down below, or you can join the Discord to ask me there or on X, whatever suit you best or suit you well. Until I talk to you next time, be safe. Wassalamu alaikum wa rahmatullahi ta'ala wa barakatuh.